outlook to Chinese economy in 2024?
Well, the general outlook for me is that the worst is behind us.
The property market, how long do you think the correction will take?
We're probably close to the bottom. My point is that there is not necessarily a sort of rebound.
What are the new engines?
But what is positive is that if you move up the value chain, you will raise the aggregate level of productivity of China.
New quality productive force.
If the end game of the strategy is to lift demand in China, then I think it's beneficial for everyone.
The Bank of Switzerland cuts the interest rates recently. Which one will be the next?
The ECB.
The disband of the Magnificent Seven.
The general story probably remains valid, but you probably want to dig deeper into the details.
欢迎收看《顶级投资人》，本期嘉宾是安盛集团首席经济学家Gilles Moec，他同时也是安盛集团旗下的安盛投资管理的研究主管。安盛来自法国，是全球最大的保险集团之一，历史超过200年。安盛集团在1994年创立了安盛投资管理，截止2023年年底，安盛投资管理旗下管理的资产规模达到8440亿欧元，是欧洲乃至全球领先的资管机构之一。2024年，中国明确了经济转型的道路，也就是通过往价值链的上游走，来提升制造业的水平和全要素生产率。Gilles在采访中表示，这一战略选择绝对是必要的。Thank you, Gilles, very much for your time to take this interview.
Most welcome.
Let's talk something about China. First of all, what is your general outlook to Chinese economy in 2024?
Well, the general outlook for me is that the worst is behind us. That 23 was definitely tough. My starting point is very simple. It's that China remains the world's biggest producer of manufactured goods. Yes. And the manufacturing cycle at the global level has been depressed since basically the reopening of the economies after COVID for very simple reasons. The manufacturing cycle seems to be normalizing. Yes. At the global level, you can see that in a number of signals, the PMIs everywhere, export orders, high up the value chain, the pipeline, for instance, microchips, you can see it, the orders are rising very, very fast. So if the manufacturing cycle does better, China is going to do better.
In terms of the property market, how long do you think the correction will take?
Historically, if you measure this as the share of residential investment in GDP, which is a potential interesting metric, there's a very interesting study by the IMF which came out in February, which would tell you that after a shock like this, residential investment as a share of GDP can remain depressed for 5 to 10 years.
5 to 10 years. I mean, if we calculate the cycle starting from 2020, now it's 4 years, so it's close to the bottom.
We're probably close to the bottom. My point is that there is not necessarily a sort of rebound. The construction sector, the real estate, it's a big boat, a slow-moving boat, and it doesn't necessarily often restart very quickly. Yes, at some point you hit bottom, so it's no longer a drag, but you still need to find something which is going to replace the fact that, yeah, it has stopped being a drag, but it's not necessarily going to be a positive factor in the years to follow. I think that's the key question for China.
We lost the old engines.
Yes.
What are the new engines?
There's an old engine which is still working, which is manufacturing. That's the point I was making at the beginning. That's there, and you're not losing ground. For all this talk about decoupling, China remains the biggest manufacturer. That's there. There's no question about this. But we need to find something to replace real estate. What China is doing at the moment, which is to try to move up the value chain, and this focus on productive quality. If it's solely used to raise exports, I think it will end up with quite a few issues. It can work, but it may trigger some tensions. But what is positive is that if you move up the value chain, you will raise the aggregate level of productivity of China. And you can do a very nice thing with productivity gains. You can actually increase real wages. And that would actually be a way to reflate consumer spending. So you've got more, continuation of innovative manufacturing, generating productivity gains, using those productivity gains to expand real wages and expand demand. And then you can get into a mutually beneficial relationship.
New quality productive force.
To me, the point is, what is the end result of this strategy? I think that the strategy in itself is definitely what is needed. You want, especially in an economy that is aging, you cannot count day in, day out on a sort of steady flow of newcomers on the labour market. You need to find something else, and that something else is productivity. Now the question is, what do you want to make of those productivity gains? If the end game of the strategy is to lift demand in China, then I think it's beneficial for everyone.
全球股市今年一季度表现亮眼，是5年来涨幅最大的第一季度。Gilles在采访中表示，未来的动力似乎没有之前那么强，而且所谓的美股科技七雄在一季度的表现也出现了明显分化，这说明投资人对人工智能的关注进入了一个更为挑剔的下一个阶段。
Fed, given the recent astonishing economic data, the job data, the CPI data, do you have some new forecast about the Fed's move this year?
Well, 6 months ago when the market was expecting 6 cuts in 2024, I was expecting 3. So now the market is expecting maybe less than 3. I'm still expecting 3 cuts in 2024, so call me stubborn. What I've done is that we've moved the timing of the first cut because we expect
starting from
July, with some risk that it slips into September, obviously. Why we changed the timing but retained the quantum, that's because I think the overall story in the US is still very much consistent with the beginning of an easing, or to be more precise, the removal of some of the restriction. Another thing is that I think in the inflation numbers at the moment, there are lots of idiosyncratic issues which have nothing to do with the underlying economic situation. At some point it's going to stop. But starting to cut rates doesn't mean that interest rates are going to fall a lot. I think the terminal rate will remain high, will remain higher than what we used to have. For me, it's a case of, central bank, Fed, starting to normalize things a bit, but 10-year yields ending the year maybe 4%.
Bank of Switzerland cuts the interest rates recently, which is the first major central bank to do the cuts. So which one will be the next?
The ECB.
ECB maybe will find some independence from the Fed.
Yeah, I mean, obviously it's true that the US market remains the dominant financial market of the world. However, in Europe at the moment, we have some very, very different dynamics than in the US. Productivity growth in the US is massively higher than what you would find in Europe. So I don't think we should consider that potential growth in Europe is getting that much higher. We should not consider that the neutral rate should be higher. So that's a big difference. And inflation is a big difference as well.
Let's talk something about the equity market. The global market had the best first quarter in 5 years, but recently we see some exhaustive signs.
I find it hard to expect much more momentum than what we've had, honestly. I think some of the very, very strong momentum at the beginning of the year was actually driven by those overly enthusiastic expectations about rate cuts. So there's the reason actually why we've seen in the last 2 weeks a measure of realism, I think, on the equity market. That's one. Second, even if I'm positive in the medium to long term on margins because I believe productivity will continue rising, for 2024, it's not obvious to me that margins will expand that much more.
The very interesting thing from the starting of this year is the disband of the Magnificent Seven. Some are still up, some are down. So what does that mean?
I think, first of all, there can be a sort of pattern around tech, which is that at the beginning of tech wave, a lot of investors are not going to necessarily discriminate that much across names. They just want to buy the narrative of the sector in general. Increasingly, once you've run through this first enthusiastic phase, first you start knowing more about some of the tech stories. You start being able to discriminate better across companies, across stories. And that would actually be consistent with the beginning of a divergence within the club. And the companies within the club, they're all techie, but they are very different techies.
Yes.
The general story probably remains valid, but you probably want to dig deeper into the details now.
Does that mean that the market euphoria on artificial intelligence will cool off a little bit?
At least it's going to be, I think, more discriminative in the sense that even if the technology in itself is great, you want to make sure that you pick the best within that technology. What I think is interesting about artificial intelligence and the impact it has on the market is that in a lot of cases, it's already very tangible. Now, I'm old enough, unfortunately, to remember the dot-com bubble.
Yes.
And at the time of the dot-com bubble, the market was basically buying promises. Very, very, very few companies with huge valuations at the time were actually selling stuff to someone. In the case of actually a number of companies which are at the forefront of the AI narrative, it's actually companies with a proper turnover which actually can sell things.
This time is different.
This time, I hate saying that. I'm normally a fairly, I would say, bearish, pessimistic kind of guy. But I'm ready to buy the general story of AI for one simple reason, which is that we can already see that in productivity gains. We see productivity improvement right now in the US, for instance, in the services sector. Mm-hmm. And I would relate this to AI. I'm not saying that AI today is explaining this. I just use this as an illustration of the fact that AI can help you both in some super sophisticated manufacturing activities and also in some very mundane, very traditional services sectors.